Thanks, everyone. So I am Alan Bowie. I'm a principal at North Castle Partners. We're a consumer-focused private equity firm based here in New York, and I'm going to spend a little bit of time just talking about what it looks like when a deal gets introduced into our investment committee, what the conversations look like around the table, what gets us excited, what makes us nervous, what might be a deal stopper, and I'll use a few real world examples to make this a little practical, and I'll genericize them a little bit to make sure that I don't get back to the office and find that compliance has turned off my key card and locked me out. But I'll just ground everyone with just a little bit of context about us. Again, we're a firm based here in New York, focused solely on the healthy, active, sustainable living sectors. And what I'd emphasize here is that we look for opportunities where we can deploy more than just capital. We want to be able to bring and leverage our 25 years of institutional experience across focused areas in order to partner with management teams and really collaborate and create value and ultimately find good outcomes for everyone involved. I just want to flash our focus areas and really just emphasize again that it's really rare that we stray outside of our focus areas because this is where we truly feel that we are able to bring our experience and sort of track record and focus areas to bear. And we've seen a lot of landmines, and we like to think that we can help others avoid them as we partner with teams to look for success. I just want to set the scene really quickly. I think we heard from the prior credit folks that the landscape has changed, right? I mean, COVID, we had access to super cheap capital. I think the prevailing philosophy was growth at all costs. And at that time, adjusted EBITDA, as the credit guys know, was very creative, let's say. And I think that's changed quite a bit. I mean, back then there were a lot of COVID fueled headwinds that distorted baselines and created a little bit of optimism that was confusing at times. And that led buyers, I think, to lean into sort of forward-looking multiples and narratives that ultimately couldn't sustain and weren't durable, in hindsight, of course. And fast forward to today, where higher cost of capital, I think, has just changed what good looks like. And unit economics and margin sustainability have really replaced top line as the primary lens. And I think we saw last year that deal volume is actually down despite dollar volume being up. And what that tells me is that buyers are pickier, but large deals at premium valuations are still happening if a lot of boxes are checked, and some of which I'll talk about how we view those in the coming slides. But the overarching theme, I'd say, for us is that the question has shifted a little bit from how fast are you growing to how durable and sustainable is that growth, and how will that translate to cash generation. And so typically discussions in our investment committee are really more of constructive conversations with the constructive dissent at times and productive. But a lot of the discussions come back to a number of key themes, some of which I'll talk to here. Firstly, does the deal fit our mandate and strategy? It seems like an obvious one, but we see a lot of potential investments that just don't fit our sector focus and risk appetite and risk profile. And that's just a very quick filter for us. Next is, well, what is the company's reason for being? Is it solving a problem for consumers? Is it creating a product for a market that might not be there? Is it trying to convince consumers rather than find the consumers that are already looking? And ultimately, we'd like to see that demand is already there, and the brand just needs to find the right time and place to show up in front of consumers. I think a structurally attractive and growing category is obvious and always a positive. And in terms of financials, we love to see high quality revenue and a high quality margin profile. As it relates to unit economics, we want to see that it's not just high growth, but it's really sustainable growth. And I think we know that unit economics really underscore the difference between a high growing company and a company that can continue to grow sustainably over the long term. And then I would really couple together the value creation plan and the management team. We really emphasize, is this a management team that we feel like we can partner with to author a value creation plan that we can execute together. You know, a fancy plan on paper really doesn't mean much if you don't partner with the right group and have the link arms with the right folks that you're confident that you can take the company to the next level with. And then lastly, I would just underscore one of the questions that comes up more and more, which is there a clear and realistic path to a successful exit here? And what I mean by that is that there's plenty of opportunities where we see really interesting and could be great companies, but there just aren't any examples of similar companies in similar industries that have exited. And ultimately, we are investors that need to seek an exit, and that can be a precluding factor for us. So I'll move to the green flags for e-commerce and consumer opportunities for us. Again, a great category with secular tailwinds is typically table stakes. But differentiation is really what matters here. And that means it could mean clear category leadership. It could mean a great position within a defensible niche. But ultimately, a company that's number one or number two in a category that's clearly defined and with a lot of white space to grow into is a lot more valuable and just a different value proposition than a better than the next brand that's in a bit more crowded of a category. And then, as I mentioned earlier, high growth, high quality, diversified and recurring revenue is really important. And that should really be coupled with scalable unit economics that are attractive as well. And OSL mentioned earlier, with respect to customer loyalty, the characterization of a cultish consumer. I think we'd love to see that. We want to see consumers that are recommending the product of their own free will and volition. They're recommending it to friends. They're posting it on social media without being paid. I think that really speaks to how strong a brand is in the market and how it resonates. And ultimately, word of mouth is one of the strongest tools for customer acquisition, right? So we really love seeing that. And I think with respect to omni-channel strength, I think we love to see proof points, and it doesn't need to be, perfect diversification, a third D2C, a third Amazon, a third retail. I think we just want to see proof points outside of a singular channel and the opportunity to grow into other channels. And then the last one I'd touch on is increasingly important, I think, in 2026, and I think many have hinted to it. Not only do we want to see a data-driven infrastructure, but I think increasingly we want to see companies that have found a way to leverage AI and really draw insights out of data rather than just outputting a monthly report that doesn't have a lot of context. And I purposely put this point at the bottom here, which is in reality, it's very rare, if ever, to check all of these boxes. And so we really look at the combination of all these things to ensure that there's really a foundation to invest behind. And so to move to the red flags, we definitely don't want to see a declining category and any sort of dynamics that might make it difficult to differentiate or, for example, a very commoditized category. And one of the things, if we want to touch on things that could be a deal killer, a deal stopper, would be unreliable financials or opaque financials. And one example might be opening up a book and seeing an adjusted EBITDA schedule that has 30 line items of adjustments, or for some reason an adjustment that is non-recurring but happens to be recurring every year for the last 10 years. It just doesn't, it makes it really challenging for us to build credibility in a forecast and in a team. And I think one of the things that I'll repeat a few times during this is that credibility is really important, and it's really easy to lose credibility, and it's incredibly difficult to regain it once you've lost it. And so you just need to find ways to stand up and make sure that you don't lose that credibility throughout an investment process. The other thing I'd point to, and I'd say unit economics tying into paid advertising, is an over-reliance on paid advertising. And what I mean by that is a lot of push marketing without any organic growth by itself. I think everyone in this room was around for April of 21 when the iOS update overnight just crashed a lot of acquisition tactics and marketing, and there was an over reliance on behavioral targeting that overnight just caused a lot of companies' growth to evaporate. I think one of the last things we want to see is if paid media is turned off, that growth turns negative. I think that just creates a very tough situation for us to invest behind. And then the other one I touched on here is negative brand reputation. It's really important for us that when we go out and look at Amazon reviews and talk to vendors and customers, that everything comes back with a thumbs up. We definitely don't want to see any product quality issues or anything like that. And an example that I would bring up from a potential investment we looked at recently was a company that actually checked almost all of the green boxes on the prior page. Great margin profile, incredibly profitable, doubling almost every year, seemingly strong customer cohorts. But once we dug into the next stage of diligence, actually relatively far down the line, we actually discovered that they employed call centers and customer support folks who used pretty predatory sales tactics to sort of prey on susceptible consumers, and that was an instant deal killer for us. So that's just one example of things that can turn off an investment team. And then one thing that might be a bit more binary for many firms, but particularly for us, are sort of litigation, regulatory, or compliance issues. And so an example there was we had sent down a diligence team to take a look at the manufacturing facilities of a company we were looking at, and despite the plant managers having quite a bit of a heads up, the diligence team quickly uncovered some mold and cockroaches right by one of the manufacturing lines, and as you can imagine, that was a deal stopper very quickly. The last thing I'd point out here is unrealistic value expectations. That can definitely be a deal stopper. I think a lot of folks can be still grounded to 2021 valuations, and at times maybe find a transaction in the market that they think is similar to theirs, but has really no analogous characteristics, and that can just make coming to an agreement pretty challenging. And so, what I'd say here is the reverse of the green flags, which is one single big red flag, particularly around integrity or credibility or the management team, can definitely be big enough to stop a deal in its tracks for us, regardless of the growth profile of the business and how good the green flags are. And so I'll just leave the group with a few parting thoughts. Firstly, we feel that growth no longer wins on its own. You really need to have a durable and sustainable growth strategy that is lasting. And the question I think around the room for us has shifted from how fast is this growing to how sustainable is the growth strategy. Second, I'll mention credibility again. We've found that it can really be a deal killer. I think one of the fastest ways to lose an investment team's interest is by losing credibility, and there's a lot of ways to do that. But ultimately, that once you lose credibility, it's really tough to regain that. So it's really important to maintain that trust through everything that you articulate and convey to the counterparty. Thirdly is the premiums for valuation go to proof, not promises. I think if you're seeking a premium valuation, prove prove that you are going to do what you say you're going to do. Prove retention, prove margin resilience, prove that you can put out a forecast with credibility that you hit, and don't whiff a month after presenting it. And I think the premium valuations will come to you. The premium valuations go to the companies that prove that they have merited that valuation. Fourth is, and I put this on here because it's a question that we get a lot, which is marketing spend really has no universal benchmark. The question we get a lot is, what's the right level of marketing relative to revenue? And I'd say there's really no right answer here, even within categories. There's only the right relationship between how much you're spending and what that spend generates. And I think there's situations where 30% marketing as a percent of revenue is appropriate if it's really generating incremental and efficient growth. And conversely, there's situations where 10% might be too much if it's driving unprofitable or negative ROI sales. And lastly, I touched on this earlier, but data hygiene, it's boring, but it is critical. And I think if you're looking to seek capital or investment in the next 12 to 24 months, I think one of the most important things you can do now is invest behind data hygiene and good data infrastructure and making sure that numbers reconcile and they're really supporting the story that you're trying to otherwise tell. And so with that, appreciate the time. And if you'd like to continue the conversation, feel free to look for me after this or after the conference. And thanks for to the group for having me here today.